Welcome to Private Asset Management's Week in Review. Today is Friday morning, September 2nd. I'm Dillion Hakes. I'm joined by our Chief Investment Officer, David Allen. David, it's been a couple weeks since we've gotten together. I've been out of the office. Glad to be back here. We closed the books on August this week. It was an interesting up and down month. What did we learn from markets during the month of August?
Well, in equity markets last month, we did see the major indices fall about 4 or 4.5%. Energy led the way despite a 10% decline in oil prices during the month. Other sectors that performed pretty well were the more defensive sectors, utilities, consumer staples. On the other hand, information technology and consumer discretionary, those are more exposed to negative impacts from higher interest rates. Those underperformed last month.
David, you mentioned that more interest rate sensitive sectors underperformed over the last month. We've obviously seen yields rise quite a bit of recent. What are we seeing on the interest rate picture?
So really across the yield spectrum, we've seen yields increase in August. On the long end, the 10-year, we've seen go from about 2.6% at the beginning of the month to about 3.25% today. And on the short end, as expectations for Fed rate increases have themselves increased, we've seen the short end of the yield curve also begin to show higher yields.
A lot of the declines we've seen of late have come just in the last few days since we had Jerome Powell speak at Jackson Hole. We talked about that a little bit last week. It seems like the market is trying to catch up with a changing expectations of what the Fed is going to do, in the fall and certainly in the next meeting. Do we think that the market has further to go to catch up to Fed expectations, or where the Fed actually is going to go?
Well, I think there are two ways to look at that. There's the sort of the ultra short term, the September meeting, what is the Fed going to do, and what are the market's expectations for that? I think there's still a lot of doubt about whether or not the Fed is going to settle with 50 basis points or 75, and ultimately that's going to be data dependent. I think the market is pretty well reflecting that right now. But further out, as we move into 2023, I think the market is still expecting the Fed funds rate to peak around 4% and then to pretty quickly begin to move back down, suggesting that the market expects there to be rate cuts in the first half of next year. I think if you look at what the Fed has said, recently, before Jackson Hole, again at the Jackson Hole conference, and then in the week since Jackson Hole, I think they're pretty consistent that they're expecting rates to be held at a high level for a fairly long period of time. And the market isn't reflecting that yet. And so as that expectation changes, potentially we could see some more interest rate volatility related to that.
We talked about interest rates moving up and that affecting certain interest rate sensitive areas of the market. But on the fixed income side of things, that actually presents some opportunities for, certainly on the shorter end of the curve, to get paid a decent premium for taking fixed income investment. We haven't seen yields this high in a number of years. What are we seeing from an opportunity perspective?
You're right. If you look at the shorter end of the Treasury yield curve, 2 years or 5 years, right now yields are right around 3.5%. They haven't been this high since going back to 2007 or 2008. So I think for an income-focused investor, someone who's looking to generate income from their investment portfolio, it might make sense to go ahead and lock in these pretty attractive yields, at least over the last decade, though we may see further rate increases.
Turning back to some of the economic reports that we saw this week, we had the market sell off. We had several of the reports that came out positive. It begs the question that we've been talking about a little bit. Is good news bad news? It seems like the market's reacting negatively to reports that have come out, surprise to the upside.
You're right. This is something we've talked about in past weeks, that we get in the situation where, good economic data tends to be a negative for markets. And that's, as it's transmitted through what the Fed is going to do with future policy. As the economy is remaining strong, that suggests that the Fed has more room to, increase interest rates faster, perhaps a bit higher than they would if the economy was weakening more.
Digging into the specifics a little bit, we got two different reports on the employment situation here in the U.S. We got a JOLTS report earlier in the week and a jobs report this morning. What did we learn?
Well, the JOLTS data for July showed an unexpected increase in the number of job openings out in the labor market. Over the last few readings, we've seen job openings beginning to decline, which suggested that labor supply and labor demand were moving into better balance. That'd be a positive for the Fed. It would mean a bit slower wage growth potentially. And so that pickup meant that wages might be growing faster. We could have a bit more of an inflationary pressure coming from the labor market as a result. And so that was obviously taken as a negative for markets, though it may be a positive for the labor market.
What about this morning's jobs report? What did we learn today?
I think overall, the jobs report this morning was pretty strong. For August, we saw 315,000 non-farm payrolls added. The really strong July numbers were revised down a bit, but again, still pretty exceptional at 526,000 non-farm payrolls added. A bit of weakness, perhaps at first blush, in the unemployment rate, which had increased to 3.7% from 3.5%. But from our point of view, this is happening for the right reasons. The right reasons being an increase in labor force participation, which is now at the highest that it's been, matching the highest that it's been since the beginning of the pandemic. As more participation comes into the labor market, that potentially means that we're going to have better balance between labor market demand and labor market supply.
What does this mean for inflation? What does this mean for wage gains going forward?
Well, tying back to one of the things we were talking about as it relates to JOLTS, if we're getting better balance between supply and demand of the labor market, that suggests that we could see slower wage growth. So anything that is perhaps showing that imbalance is increasing, that is perhaps exerting an inflationary pressure on the economy. But again, this morning's data suggests that we're getting a better balance, which might mean that we could see less inflationary pressure coming from wage growth as we end the year.
The last report we saw this week, we got a report out of ISM Manufacturing. Seemed to surprise a bit to the upside. Markets reacted negatively to the news. What did we learn specifically inside the report?
The headline ISM Manufacturing Index did surprise to the upside, coming in ahead of the consensus expectation. Some of the sub-indices that feed into that headline, I think, are even have more positive takeaways. First and foremost, the prices paid index, which fell 7.5 points after an even sharper decline in the prior month. That suggests that the input costs that manufacturers are seeing for their manufacturing process are coming down. That should translate into lower producer prices, and eventually those flow into consumer prices. That's a good sign for the inflationary outlook. In addition to that, supplier delivery times are elongating still, but again, at the slowest pace that we've seen since the pandemic began. So, improving supply chains, meaning slower inflationary pressures for the manufacturing sector.
All right, David, what do we have on the calendar for next week?
Well, we just finished talking about ISM Manufacturing. Next week, we'll see the partner report to that report, ISM Services, give us an update on how activity in the service sector is trending. And then midweek, we'll see international trade balances, get a look at U.S. imports and exports and how those are performing in late summer. And then at the end of the week, I think one of the more unheralded reports that I'm going to be focused on is the financial accounts of the United States, which offers us an opportunity to look at balance sheets of households and businesses to see how they're performing at this stage of the recovery.
We'll look out for that report next week. I think it will be interesting to see, where the state of the consumer balance sheet is. There's a lot of discussion about inflation and how that's eating away at consumers. So it'll be really interesting to see where they're at and how that looks going forward. I want to thank everybody for joining us for Private Asset Management's Week in Review. If you like our video series, as we always say, go ahead and please subscribe, like our video on YouTube. I want to wish everybody a very happy and safe Labor Day. Be safe, have some fun out there in the sun. Stay cool if you're here in San Diego. It is sweltering this week. We'll see everybody next week.